Tonight, you will learn the real difference between stocks and ETFs in a way that is easy to follow and feels calm to hear. You will understand exactly what each one is, how they work, and the key reasons investors choose one over the other. You will see how they compare in cost, risk, and potential growth, without rushing or using complicated words. This is not a lesson you have to struggle through. We will move slowly, one idea at a time, until it feels natural to you. By the end of this video, you will know how stocks give you ownership in a single company, and how ETFs give you a basket of investments in one purchase. You will know how each choice can affect your money over time, and what kind of investor usually prefers each. You will also hear how these choices connect to feelings like safety, control, and confidence with your money. This is information you can use whether you are starting with your first investment or improving the way you already invest. We will start with the basics and move toward the deeper details, so nothing feels confusing or out of reach. You will hear about diversification, which is a way to spread your money to reduce risk. You will learn how fees work in both stocks and ETFs and why they matter. You will also hear about taxes in a simple way, so you know what to expect and can avoid surprises. And you will see how market changes affect both, so you can feel steady even when prices move. This is not about telling you which is better. It is about helping you see them clearly, so you can choose what matches your own comfort and goals. By the time we finish, you will have a complete picture. You will feel sure about the words stock and ETF instead of guessing or feeling left out in conversations. You will also know a few gentle steps you can take next if you want to put this knowledge into action. For now, all you need to do is listen. We will take each part slowly so the ideas settle in without pressure. The goal is for you to leave here with both calm and clarity. And as we move through the first chapter, you might notice something interesting. Knowing the difference between stocks and ETFs is not only about investing, it can also tell you something about the way you think about safety, choice, and the future. That is where our story begins. It often starts with a passing comment, maybe at work, during lunch, or while waiting for coffee. Someone says they are investing in stocks. Another person mentions ETFs. You hear the words together for the first time, and they sound important. But in that moment, you are not sure what they mean. You smile and nod, keeping the questions to yourself. Later, though, the words stay with you. They feel like something you should know, even if no one ever taught you. For many people, this is where the journey begins. It is not a grand decision or a planned learning moment. It is a small spark of curiosity mixed with the quiet discomfort of not knowing. You might tell yourself you will look it up later. Sometimes you do. Sometimes it waits for weeks or months. But once you have heard the words, they have a way of coming back. A headline on your phone, a post online, a video thumbnail promising quick answers. The world seems to speak a language you want to understand. The first step is to slow down. You do not have to know everything at once. You do not have to jump into investing tomorrow. This moment is about understanding what these words mean in the simplest way. A stock is a share of a single company. If you own a stock, you own a small part of that company. You share in its successes and its struggles. An ETF is a collection of investments, often holding many different stocks, sometimes bonds or other assets too. When you own an ETF, you own a piece of that whole collection. That is the surface definition. But there is more beneath it. A stock can rise or fall in value based on how the company performs and how investors feel about it. This means the price can change quickly, sometimes in ways that surprise you. An ETF's value changes too, but because it holds many different investments, the changes are often less sharp. Some parts may rise while others fall, balancing each other out. This is why people say ETFs can feel safer. It is not that they cannot lose value, it is that the changes are often smoother. You might wonder why someone would choose one over the other. Stocks offer the chance to focus on a company you believe in. They can grow quickly if that company succeeds, but they also carry the risk of losing value if things go badly. ETFs spread the risk across many companies or assets. You may not see the same large jumps in price, but you may also avoid the hardest falls. Both have their place. The choice depends on your goals, your comfort with risk, and how much time you want to spend watching the market. At this stage, you do not have to decide which is better for you. You are still gathering the pieces of the picture. What matters is knowing that these words are not mysterious codes. They are tools. Like any tools, They work best when you know how they fit your needs. In the next chapter, we will start to explore what it means to truly own part of a company. We will look at stocks not as numbers on a screen, but as a way of holding a real stake in something that exists in the world. And as you hear that part of the story, you might notice a deeper question forming. If owning a stock means owning part of a company, what does that say about the responsibility and the connection you have to it? That is where we go next. Owning a stock is more than seeing a ticker symbol on a screen. It means you own a real piece of a real company. It could be a well-known brand you have seen your whole life, or a small business that is just beginning to grow. That share is proof of ownership. It is not a loan. It is not a promise. It is your stake in the company's story. If the company does well, the value of your share can rise. If it struggles, the value can fall. This connection between the company's life and your investment is what makes stocks feel personal for many investors. Think of the places you interact with every day. The store where you buy groceries. The company that makes your favorite sneakers. The streaming service you watch at night. Many of these companies sell shares on the stock market. When you buy a share, you are linking part of your money to their future. You are no longer just a customer. You are an owner, even if it is only a very small percentage. You have the right to benefit from the company's growth and, in some cases, even vote on certain company decisions. This ownership gives stocks a unique kind of appeal. It can be exciting to feel connected to a company you admire. If you believe in its products or leadership, owning shares can feel like participating in its success. You are there for each quarterly update, each new product release, each milestone. This is why many investors choose to buy shares in companies they understand and trust. They want their money to support businesses they believe will grow over time. But this connection also comes with responsibility and risk. Companies face competition, changing markets, and economic shifts. A product might fail. A new competitor might appear. Leadership might make a poor decision. Any of these events can cause the company's stock price to drop. When that happens, the value of your investment drops to this. Why stocks are often called a higher risk investment compared to something like an ETF, which spreads the risk across many companies. Some companies also pay dividends, which are regular payments to shareholders from the company's profits. These can be a source of steady income while you hold the stock. Not all companies pay dividends, but those that do often attract investors looking for income as well as growth. Dividends can be reinvested to buy more shares or withdrawn as cash. They are a way for companies to share their profits with the people who own them. When you own an individual stock, your investment's performance depends almost entirely on the company itself. If it grows and earns more money, your share's value can increase. If it loses money or faces challenges, your share's value can decrease. This direct connection is what makes stocks both appealing and risky. You have the potential for strong gains, but you are also exposed to bigger losses compared to owning a broader mix of investments. Many first-time investors are drawn to well-known companies because they feel familiar. There is comfort in choosing something you recognize, but familiarity does not guarantee success. Even strong, famous companies can experience sudden declines. Market conditions, economic changes, or shifts in consumer habits can affect their value. This is why understanding the company's health, its business model, and its place in the market is important before investing. Some investors choose to build a portfolio of different stocks to spread out their risk. This is called diversification. By owning shares in multiple companies across different industries, you reduce the impact if one company's value drops. Still, this approach requires time, research, and attention. You need to follow each company, understand its performance, and make decisions about whether to hold, sell, or buy more shares. For some people, this is a satisfying part of investing. For others, it can feel like too much to manage. When you own a stock, you also experience the emotional side of investing. Prices change every day, sometimes every hour. It is easy to feel excitement when the value rises and worry when it falls. This emotional pull can lead to quick decisions like selling too soon or buying at the wrong time. Learning to stay steady, to focus on the bigger picture, is one of the most important skills in stock investing. It is about seeing beyond the daily numbers and keeping your attention on the long-term story. Stocks are one of the oldest and most direct ways to invest in a company's growth. They have helped build wealth for many investors over decades, but they require patience, resilience, and a willingness to accept the ups and downs. Understanding this from the start can help you approach them with a clear mind and realistic expectations. You are not looking for quick wins. You are looking for steady growth that matches your goals and risk comfort. For someone starting out, stocks can be a valuable learning experience. By following a company's performance, reading its reports, and seeing how it responds to challenges, you begin to understand how businesses work and how markets react. This knowledge can make you a better investor over time. Even small investments in a few companies can teach you lessons that guide your future choices. But there is another way to invest that offers ownership without tying your success to a single company. This is where ETFs come in. Instead of putting all your money into one company, an ETF lets you own a small piece of many companies at once. It is still investing in the market, but with a different structure that can change how you experience the ups and downs. In the next chapter, we will explore this approach in detail, so you can see how it compares to owning individual stocks and why many people choose it as their starting point. And as we begin that part of the story, you might find yourself asking an important question. If stocks connect you deeply to one company's fate, what does it feel like to spread your connection across dozens or even hundreds of companies at the same time? That is where we will go next. An ETF, or exchange-traded fund, is a way to invest in many things at once. Instead of putting your money into a single company like you do with a stock, you buy into a fund that holds a mix of investments. These can be stocks from different companies, bonds, or other assets. When you buy one share of an ETF, you own a small portion of everything inside it. That means your money is spread out automatically, even with a single purchase. This built-in mix is called diversification, and it is one of the main reasons people choose ETFs. With a stock, your outcome depends on one company's performance. With an ETF, the rise or fall of one company has less impact because other companies in the mix can balance it out. If one investment has a bad day, the others can help soften the drop. This can make the overall ride smoother, which can feel less stressful for investors who prefer stability. ETFs work in a way that feels familiar if you understand stocks. They are traded on the stock exchange, so you can buy and sell them during market hours at market prices. This makes them different from traditional mutual funds, which are priced only once a day. With an ETF, you can see its price change throughout the day, just like with a stock. This flexibility appeals to many investors who want both variety and control. One of the quiet strengths of ETFs is how easy they make diversification. Building a mix of individual stocks yourself takes time and often more money. You would need to research each company, choose how many shares to buy, and keep track of them over time. With an ETF, you skip much of that work. The mix is already built for you based on the ETF's specific goal. Some ETFs track a broad market index, like the S&P 500. Others focus on certain industries, like technology or healthcare. Some even mix in bonds or international stocks. ETFs also vary in how they are managed. Many are passively managed, which means they follow a set list of investments based on an index. This approach usually has lower fees because there is less active decision-making. Some ETFs are actively managed, with a team choosing investments in an effort to outperform the market. These may have higher fees, but they aim to give investors an edge. Knowing which type you are buying is important, as it affects both cost and potential performance. Fees in ETFs are called expense ratios, and they are expressed as a small percentage of your investment. Even though they may look tiny, these costs add up over time. A lower expense ratio means you keep more of your returns. This is one reason many investors prefer index ETFs, which often have very low fees compared to actively managed funds. Over years, saving even a small fraction in fees can make a noticeable difference in your total return. ETFs can also be tax efficient. In the United States, the way ETFs are structured allows them to limit the amount of taxable events that pass on to investors. This is not the only factor in choosing an investment, but it can make ETFs attractive for people who want to keep taxes lower without extra effort. It is worth remembering that you still pay taxes when you sell your ETF for a gain, and dividends are also taxable. But compared to some other investment types, ETFs can be gentler on your tax bill. Another reason ETFs are popular is accessibility. You can start with a small amount of money and still own a variety of companies. You do not need to pick winners yourself or build a portfolio piece by piece. This makes ETFs appealing for beginners. but they are also used by experienced investors who want to fill specific gaps in their portfolio. For example, an investor who owns mostly US stocks might buy an international ETF to gain exposure to other countries' markets. Like any investment, ETFs have risks. The value of your ETF can go down if the investments inside it lose value. If the ETF tracks a specific sector, like energy or technology, it will be more affected by changes in that sector. Even broad market ETFs will fall when the overall market declines. Diversification reduces risk, but it does not remove it. This is important to keep in mind, especially during times of market volatility. One of the challenges with ETFs is choice. There are thousands available, each with a different focus, cost, and strategy. It is easy to feel overwhelmed by the options. This is where knowing your goal helps. Are you looking for broad exposure to the whole market? Do you want to focus on a specific industry? Do you prefer low fees and a long-term approach? Or are you willing to pay more for active management? Answering these questions can narrow the list and make the decision easier. ETFs can also be a way to invest consistently over time. Many people set up automatic purchases, adding a little to their investment each month. This steady approach, sometimes called dollar-cost averaging, can smooth out the impact of market ups and downs. It turns investing into a quiet habit rather than a series of big, stressful decisions. Over time, these small, regular investments can grow into something significant. For some, the appeal of ETFs is peace of mind. Knowing that your money is spread across many investments can reduce the urge to check prices constantly. You do not have to track every company's earnings or news. You can let the fund's design do much of the work for you. This does not mean you never need to review your investments, but it can mean fewer moments of anxiety and more time focusing on your bigger financial picture. ETFs can be a powerful way to build wealth gradually, but they are not the only way. In the next chapter, we will look at how ETFs compare to index funds, another investment type that also offers diversification, but works a little differently. This will help you see where ETFs fit in the larger investing world and how to decide between them. And as we step into that part of the story, you might wonder something important. If ETFs and index funds both spread your money across many investments, why do so many people prefer one over the other? That is the question we will answer next. If you have heard about ETFs, you have likely also heard about index funds. Sometimes the terms are even used in the same sentence as if they are interchangeable. They are related, but they are not exactly the same. Both are ways to invest in a group of assets instead of a single company. Both offer diversification, which can help reduce risk. But the way they are structured and traded makes them different in ways that matter for certain investors. An index fund is a type of mutual fund that aims to match the performance of a specific index. An index is simply a list of investments that represent a part of the market. The S&P 500, for example, includes 500 of the largest US companies. When you buy shares of an index fund that tracks the S&P 500, you are buying small pieces of all those companies. The goal is not to beat the index, but to match it as closely as possible. ETFs can also track indexes, and many do. An S&P 500 ETF works in a similar way to an S&P 500 index fund. Both give you ownership of all the companies in that index. The main difference is how you buy and sell them. ETFs are traded on an exchange, so their prices change throughout the day, just like individual stocks. Index funds are priced only once per day, after the market closes. If you place an order to buy or sell an index fund, the transaction will happen at that end-of-day price. This difference in trading can affect how investors use these funds. Some prefer the flexibility of ETFs because they can adjust their positions during the day. Others do not mind the once-a-day pricing of index funds, especially if they are focused on long-term growth and do not plan to trade often. If your approach is to invest steadily over time without watching the market closely, the trading style might not matter much. But if you value the ability to buy or sell at specific times during the day, ETFs may feel more convenient. Fees are another area to compare. Both ETFs and index funds can have low expense ratios, especially when they track well-known indexes. Over time, low fees can make a meaningful difference in how much of your returns you keep. Some index funds have slightly higher minimum investment requirements, while ETFs often let you start with a single share. In recent years, Many brokers have removed trading commissions for ETFs, which has made them even more accessible. One reason some investors still choose index funds over ETFs is automation. Many retirement plans and brokerage accounts make it easy to set up automatic purchases of index funds. While you can also automate ETF investing, the process may be slightly different depending on your broker. For people who want a completely hands-off approach, index funds in an automatic plan can feel effortless. Tax efficiency is worth noting too. ETFs generally have an advantage here because of how they are structured. The process they use to create and redeem shares can limit taxable events inside the fund. Index funds are still tax efficient compared to many actively managed funds, but they may generate more taxable distributions in certain years. For long-term investors, this difference can be small, but it is something to be aware of. The truth is, you do not have to pick only one. Some investors hold both ETFs and index funds. They may use index funds in their retirement accounts for automation and ETFs in their regular accounts for flexibility. Others simply choose the one that fits their style best and stick with it. What matters most is not whether you pick the right one, but whether you understand how each works and how it supports your goals. For a new investor, the choice between ETFs and index funds can feel bigger than it really is. Both are strong tools for building wealth steadily over time. Both help you avoid the risk of relying on a single company's success, and both can be kept in your portfolio for years with relatively little maintenance. Once you know the differences in trading, fees, and automation, you can decide which one feels easier and more comfortable for you. This connection between ETFs and index funds often surprises people. They realize they have been comparing to investments that are more alike than different. It is a little like meeting distant relatives and noticing the same expressions or gestures. They share the same foundation, but their day-to-day habits are what set them apart. And once you understand this relationship, you can move forward with less confusion and more confidence. In the next chapter, we will shift from the structure of these investments to the way they are managed. You will hear about the difference between active and passive investing, and why this choice affects not only your returns, but also your peace of mind. It is one thing to decide between ETFs and index funds. It is another to decide whether you want someone actively choosing your investments or simply following a set plan. And as we step into that topic, you might ask yourself a question that goes beyond investing. In your life, do you prefer to take control of every choice, or do you feel calmer when you follow a clear, proven path? That is where we go next. When people begin investing, one of the first decisions they face is whether to take an active or passive approach. These terms describe how the investments inside a fund are chosen and managed. The choice may sound technical, but it affects how much you pay in fees, how much attention you give your investments, and even how you feel about the ups and downs of the market. Active investing means there is a manager or a team making decisions about what to buy and sell. They study market trends, company performance, and economic data. Their goal is to beat the market, to earn better returns than a broad index like the S&P 500. This approach can feel appealing because it suggests someone is working to protect and grow your money. You might imagine a professional watching over your investments, ready to act when an opportunity appears or when danger is ahead. A passive fund follows a specific index and owns all or most of the investments in that index. The thinking here is that over time, markets tend to rise, and trying to pick the right winners and avoid the losers is hard, even for experts. By simply following the index, you avoid the costs and risks of frequent trading and still capture the overall market's growth. The cost difference between the two approaches is one of the most noticeable. These fees are taken from your returns, which means they can add up over time. Passive funds, including many ETFs and index funds, typically have much lower fees. The lower the cost, the more of your money stays invested and working for you. Performance is another point to consider. While some active managers outperform the market in certain years, research shows that over long periods, many do not. Consistently beating the market is difficult. Even skilled managers can have periods of underperformance. Passive investing accepts this reality and focuses on keeping costs low and staying invested through market cycles. It is a slower, steadier approach that does not rely on predicting the future. Your personality plays a role in which approach feels better for you. If you like the idea of experts making active choices and you are comfortable with the possibility of higher costs for the chance of higher returns, active funds might suit you. If you prefer simplicity, lower costs, and a plan that runs with minimal interference, passive investing may feel more comfortable. Neither is right or wrong. The best choice is the one that matches your comfort level and your long-term goals. Active and passive investing can also be combined. Some investors keep most of their money in passive funds for stability and use a smaller portion for active investments in areas they believe have special potential. This blend allows for both steady growth and targeted bets on certain opportunities. The balance between the two can change over time as your goals and risk tolerance shift. It is important to remember that both active and passive funds still carry risk. Market downturns affect both. An active manager cannot always avoid losses, and a passive fund will follow the market down when prices fall. This is why understanding your time horizon, how long you plan to keep your money invested, is important. The longer your time frame, the more you can ride out short-term swings and focus on long-term results. For many people, the decision between active and passive investing is as much about peace of mind as it is about performance. Passive investing offers predictability and low costs, which can help reduce stress. Active investing offers the possibility of higher returns and the comfort of knowing someone is actively monitoring the situation. Both approaches have a place in the investing world, and your choice can change as you learn and grow as an investor. As you think about these two paths, it can help to step back and see them in the larger picture of your financial life. This is not just about choosing investments. It is about deciding how much control you want over your financial journey and how much you want to hand over to others. Some people feel empowered by taking the wheel. Others feel relieved when they can set a steady course and trust the system to carry them forward. In the next chapter, we will focus on one of the core ideas we have touched on before, diversification. You will see why spreading your investments across different areas can bring balance, reduce risk, and help you stay calm when markets shift. We will also explore how diversification works differently for stocks, ETFs, and funds, and why it is one of the most trusted principles in investing. And as we move into that part of the story, you might start to wonder something simple but important. If diversification is such a steadying force in investing, how much is enough to feel safe without spreading yourself too thin? That is the question we will begin to answer next. Diversification is a long word for a simple idea. It means not putting all your money in one place. In investing, this is one of the most trusted ways to reduce risk. When you spread your money across different investments, you are less affected if one of them does poorly. The gains from other investments can help balance the losses, making the overall ride smoother. This is why so many experienced investors keep talking about diversification. It is not complicated, but it can be one of the most powerful habits you develop. Think of it this way. If you own only one stock, your results depend completely on that one company. If it has a strong year, you may see big gains. But if it has a bad year, your investment can drop sharply. If you own shares in several companies from different industries, the risk is more spread out. One company's struggles may be softened by another company's success. This is the heart of diversification, balanced through variety. ETFs make diversification easy because they are built to hold many investments at once. A single ETF might give you exposure to hundreds or even thousands of companies. You can also choose ETFs that focus on certain sectors, countries, or types of assets, and then combine them for even broader coverage. Index funds do something similar. They follow a list of investments, giving you instant variety without needing to buy each piece individually. Diversification is not only about owning many investments, it is also about owning different kinds of investments. Stocks, bonds, real estate funds, and even cash all behave differently under various market conditions. When the stock market drops, bonds might hold steady or even rise. When interest rates change, certain assets may react in opposite ways. Having a mix of these can help protect you from being too dependent on one area of the market. Some investors take diversification further by investing across different regions. They might own US stocks, international stocks, and emerging market stocks. The idea is that different economies grow at different times. By being present in more than one, you increase your chances of benefiting from growth somewhere, even if one market is struggling. This is not about chasing quick wins. It is about building a foundation that can handle the changes that come over years. It is important to know that diversification does not remove risk completely. All investments can lose value at the same time during certain market conditions. In a global downturn, almost every asset type may fall together. But diversification can still reduce the size of the drops and make recovery easier. It works best as part of a long-term plan, where the goal is to grow steadily and avoid the extreme swings that can happen when you are concentrated in one area. The right amount of diversification depends on your goals, your time frame, and your comfort with risk. Some people prefer a simple approach, using one or two broad ETFs that cover most of the global market. Others prefer to hold several different funds, each with a specific focus. There is no single correct answer. The goal is to choose a mix that helps you sleep well at night, while still giving your money a chance to grow. One of the challenges with diversification is knowing when it becomes too much. Owning too many overlapping funds or stocks can make your portfolio harder to manage without adding much extra benefit. If two ETFs hold many of the same companies, you are not truly adding variety. This is why reviewing what is inside each fund matters. It helps you see whether you are spreading risk or simply repeating it. For beginners, diversification can feel like a safety net. It allows you to start investing without feeling like every choice has to be perfect. Even if one investment does poorly, the others can help keep you on track. Over time, as you learn more about the market, you may adjust your mix to fit your changing goals. But the habit of spreading your investments will always be valuable. In the next chapter, we will look at risk in a more personal way, not just as a number or a chart, but as something you feel. We will talk about volatility, the ups and downs of investment values, and how it connects to your comfort level. This will help you see why some people prefer the steady path, while others are comfortable with more movement in the hope of higher returns. And as we move into that conversation, you might find yourself asking a deeper question. Is the goal of investing for you to grow as much as possible, or to grow in a way that lets you feel calm along the way? That is the choice we will explore next. Risk is one of those words that people hear often in investing, but do not always understand in full. Some think of it as the chance of losing money. Others see it as the trade-off for the possibility of making more. In reality, risk is a mix of both, and it is something every investor experiences. It is not something you can remove completely. Instead, you learn how to work with it in a way that feels steady for you. One way risk shows up is through volatility. This simply means how much and how often the value of an investment changes. High volatility means the price can rise and fall quickly, sometimes by large amounts. Low volatility means the price moves more slowly with smaller changes. Volatility is not automatically bad or good. It is a measure of movement, and how you feel about that movement depends on your goals and your comfort level. Stocks often have higher volatility. A single company's value can swing in response to news, earnings reports, changes in leadership, or shifts in the economy. This can be exciting when prices go up, but it can also be stressful when they go down. ETFs, especially those that hold a wide range of companies, tend to have lower volatility because the ups and downs of individual stocks can offset each other. When one company's value drops, another's rise might help keep the overall value steadier. Your reaction to volatility is personal. Some people can watch their investment drop in value and still feel calm because they believe it will recover over time. Others find even small drops hard to ignore. They may feel an urge to sell when prices fall, which can lock in losses. Knowing how you react to price changes can help you choose investments that you can hold on to comfortably, even when the market moves sharply. The time frame for your goal matters here. If you are investing for something far in the future, like retirement, you have more time to recover from short-term losses. That means you might feel comfortable taking on more volatility in exchange for the potential of higher long-term growth. If you are investing for something in the next few years, you might prefer investments with lower volatility to protect the value in the near term. Risk is not something to fear, but something to understand. Every investment carries some level of it, even cash in a savings account, which can lose value over time due to inflation. The key is finding the balance of risk and reward that fits your needs and personality. This balance is often built through diversification, which spreads your investments across different assets so that no single event affects everything you own. The relationship between risk and reward is at the center of investing. Generally, investments with higher potential returns also have higher volatility. Investments with lower potential returns tend to have lower volatility. This is why stocks, which can grow a lot over time, also move up and down more than bonds, which grow more slowly but with fewer sudden changes. The choice between them is not about which is better, but about which matches your comfort level and your timeline. There is also a difference between short-term and long-term risk. In the short term, stock prices can drop quickly, sometimes for reasons that have little to do with the company's true value. In the long term, those drops may be outweighed by years of growth. For some investors, focusing on the long term helps them accept short-term volatility. For others, short-term changes feel too uncomfortable, even if they believe in long-term growth. Market declines, often called downturns or corrections, are a normal part of investing. They happen regularly, and they are usually followed by recovery. The challenge is staying invested during these times without letting fear take over. Selling during a downturn can mean missing the recovery that follows. Building a portfolio with a level of volatility you can live with makes it easier to hold on during rough periods. ETFs can help with managing volatility because they spread risk across many investments. This does not mean they cannot lose value, but the losses may be less severe than in a single stock. This can make ETFs feel more comfortable for those who are still learning to handle market ups and downs. On the other hand, some investors enjoy the more direct connection to a company that comes with owning individual stocks, even if it means more volatility. It is also worth noting that not all ETFs have the same level of volatility. Some focus on specific industries or markets that can be more sensitive to changes. A technology ETF, for example, may have bigger swings than a broad market ETF. This is why knowing what is inside your investment matters. The label ETF alone does not guarantee a certain level of stability. Risk tolerance, or your ability and willingness to handle volatility, is not fixed. It can change with your experience, your financial situation, and your stage of life. Someone new to investing might start with lower volatility investments and later feel ready to take on more risk. Someone close to retirement might shift toward lower volatility investments to protect what they have built. The important part is adjusting your investments so they fit where you are now. It is helpful to think of volatility in the context of your whole portfolio, not just individual investments. A portfolio with a mix of higher volatility and lower volatility assets can give you growth potential while still offering stability. The mix is personal, and it does not need to match anyone else's. The goal is to create a portfolio that lets you stay invested without constant worry. Risk is part of every investor's journey. Learning how it works and how you respond to it can make you a more confident investor. You will know when a drop is something to watch calmly, rather than react too quickly. You will be able to choose investments that let you focus on your long-term plan rather than short-term changes. In the next chapter, we will look at costs in investing. These costs may seem small, but they add up over time and can affect how much your investments grow. We will explore expense ratios, trading fees, and other costs in both stocks and ETFs. You will see why keeping costs low is one of the simplest ways to improve your results. And as we move into that topic, you might start to wonder something practical. If two investments aim to do the same thing, but one costs more, what exactly are you paying for, and is it worth it? That is where we will go next. Every investment has a cost, even if you do not see it right away. Some costs are clear, like a fee you pay when you buy or sell. Others are hidden inside the investment itself, quietly taking a small piece over time. These costs may seem small, but over years they can have a big effect on how much your investment grows. Learning what these costs are and how they work helps you keep more of your money. One of the most common costs in funds like ETFs and mutual funds is called the expense ratio. This is a yearly fee shown as a percentage of the amount you have invested. If you have $1,000 in a fund with an expense ratio of 0.10%, you pay $1 each year for every $1,000 you invest. The payment is taken out of the fund's earnings automatically, so you do not have to send money yourself, but it still reduces the amount you keep. The difference between a low expense ratio and a high one might seem small at first, but over time, that difference can grow into thousands of dollars. A fund with a higher expense ratio has to work harder to give you the same result as a lower cost fund. This is why experienced investors often look for funds with the lowest expense ratio they can find that still meet their needs. If you invest in individual stocks, you do not pay an expense ratio, but you may still pay a trading fee when you buy or sell. Many brokers now offer commission-free trades, but it is always worth checking before you place an order. Even small fees can add up if you make many trades in a year. Some funds cost more because they are actively managed. This means a team of people is choosing what to buy and sell in the hope of doing better than the market. Active management takes research, analysis, and frequent trading, all of which cost money. These higher costs are passed on to investors through higher expense ratios. Whether these higher fees are worth it depends on how well the fund performs compared to cheaper options. Another cost is called turnover cost. This is not listed on your statement, but it is built into the fund's performance. When a fund buys and sells investments, often it pays trading fees and sometimes affects the price of the assets it trades. These costs can lower the fund's returns. Passive funds, like many index ETFs, usually have less turnover and lower related costs. Taxes can also act like a cost. If you sell an investment for more than you paid, you will owe tax on the profit. Some funds also pass gains from their own trading to investors each year, even if you did not sell your shares. ETFs often limit these taxable events because of how they handle trading inside the fund, which is one reason they are considered tax efficient. Understanding your costs helps you compare investments more clearly. Two ETFs might both track the same index, but one might charge more than the other. If the lower cost one performs the same, it leaves more in your pocket. The same applies to active funds. If you choose one with higher fees, it should offer something extra that makes the cost worthwhile. It is not always about picking the cheapest option. Sometimes paying a little more for a fund that matches your exact goal or gives you access to a specific market can make sense. The important thing is knowing what you are paying and why, instead of letting costs slip by unnoticed. Checking your investment costs does not need to take long. Once or twice a year, you can review your portfolio and see the expense ratios of your funds. If you find one that is much higher than similar options, you can decide whether to keep it or switch to something more cost-efficient. Small changes like this can increase your long-term results without taking on extra risk. When you know your costs, you have more control over your investing. You understand where your money is going, and you can make choices that help your investments grow more effectively. It turns the quiet drain of high fees into something you can manage and reduce. In the next chapter, we will turn to something that can add to your returns, instead of taking from them, dividends. We will talk about how dividends work for both stocks and ETFs, why some investors seek them out, and how reinvesting them can help your wealth grow faster. And as we step into that part of the story, you might find yourself wondering something simple but important. If your investments pay you regularly, is it better to spend that income now or let it stay invested so it can keep working for you? That is the choice we will explore next. Dividends are one of the most steady and comforting parts of investing. They are payments that companies or funds make to their shareholders, usually from the profits they earn. When you own a stock in a company that pays dividends, you receive a small portion of the company's earnings. When you own an ETF or a mutual fund, the dividends from the investments inside the fund are collected and passed on to you. These payments can arrive monthly, quarterly, or sometimes once a year, depending on the company or fund. They can be sent to you as cash that you can spend or reinvested automatically to buy more shares. Over time, reinvesting dividends can make a big difference because each new share you buy can also earn its own dividends in the future. This creates a snowball effect where your income and investment growth build on each other. Some investors choose companies or funds specifically for their dividends. These are often called income investors. They may prefer to receive regular payments that can help cover expenses or provide a steady stream of extra income. Others reinvest their dividends, focusing on growth now and planning to use the income later. Both approaches can work, depending on your goals and needs. Dividends are not guaranteed. A company can decide to reduce or stop its dividend if it faces financial trouble or wants to use its profits for other purposes, like expanding the business. This is why some investors focus on companies with a long history of steady or growing dividends. These companies are often called dividend aristocrats, and they are known for maintaining payouts through different market conditions. ETFs that focus on dividends work in a similar way. They hold a group of dividend-paying stocks and pass the income to shareholders. These funds can provide instant diversification among dividend payers, reducing the risk that comes from relying on a single company's dividend. They can also make it easier for new investors to build an income-focused portfolio without having to research each company individually. Dividends can also act as a cushion during times when stock prices are falling. Even if the value of your investment drops, receiving dividend income can provide a sense of progress and stability. It can remind you that your investment is still working for you, even when market prices are down. This steady income can help you stay invested through tough periods, which is important for long-term growth. The decision to spend or reinvest dividends is personal. Spending them can provide immediate benefits, especially for those who rely on their investments for income in retirement. Reinvesting them can accelerate the growth of your investments, giving you more income in the future. Many investors do a mix reinvesting dividends, while they are building their wealth and spending them later when they need the income. Taxes are another part of the picture. In the United States, dividends are usually taxed in the year you receive them. The tax rate depends on whether the dividend is qualified or ordinary. Qualified dividends are taxed at the lower long-term capital gains rates, while ordinary dividends are taxed as regular income. Understanding how your dividends are taxed can help you plan and avoid surprises. Dividends are not the only reason to invest, but they can be a powerful addition to your portfolio. They provide flexibility, the choice between taking income now or reinvesting for later. And they can be a sign of a company's financial strength. A steady dividend can show that a company is generating consistent profits and is confident enough to share them with its shareholders. For many investors, dividends become more meaningful over time. In the beginning, the payments might be small, just a few dollars here and there. But as your investments grow and the dividends are reinvested, the income can grow too. Decades later, it can become a significant part of your total return and a reliable source of financial support. In the next chapter, we will explore another way investments return value, capital gains. While dividends are like regular paychecks from your investments, capital gains come from selling something for more than you paid. They are less predictable, but they can sometimes be larger. Understanding how both dividends and capital gains work together can give you a clearer picture of your total returns. And as we step into that part of the discussion, you might start to wonder something that connects the two. If dividends feel steady and capital gains feel unpredictable, how do you balance them in a way that keeps both your growth and your peace of mind? That is where we will go next. While dividends are like quiet, regular paychecks from your investments, capital gains are a different kind of reward. A capital gain happens when you sell an investment for more than you paid for it. The difference between the purchase price and the selling price is your gain, and it becomes part of your overall return. If you buy a stock for $50 and later sell it for $70, you have a $20 gain per share. This profit is separate from any dividends the stock may have paid while you owned it. In some cases, capital gains can be large, especially if you hold the investment for many years and its value rises significantly. Capital gains can be short-term or long-term. If you hold an investment for 1 year or less before selling, the gain is considered short-term and is usually taxed at your regular income tax rate. If you hold it for more than a year, it is a long-term gain, and the tax rate is often lower. This difference is one reason many investors choose to hold their investments for longer periods. Beyond the growth potential alone, unlike dividends, which can be planned and often feel predictable, capital gains depend on when you choose to sell and how the market has performed. This means they can be less certain. You might plan to sell an investment for a gain, but market conditions can change, making it less attractive to sell at that moment. Patience can be important here, as selling too quickly can mean missing out on larger future gains. ETFs and mutual funds can also generate capital gains inside the fund when the manager sells investments. These gains are sometimes passed to shareholders, even if you did not sell your own shares. ETFs are often more tax efficient in this area than mutual funds, because of the way they handle buying and selling within the fund. Still, it is something to be aware of when looking at your yearly tax documents. Capital gains are part of the total return you get from investing, along with dividends. Some investments focus more on growth and may not pay dividends at all, instead reinvesting all profits into expanding the company or increasing its value. Technology companies are a common example. The idea is that the company's growth will eventually be reflected in the stock price, giving investors capital gains when they sell. Balancing dividends and capital gains in your portfolio depends on your needs and goals. If you want regular income, you might choose more dividend-paying investments. If you are focused on long-term growth, you might lean toward investments that aim for higher capital gains. even if they do not pay much in dividends. Many investors choose a mix, so they have both the steady income of dividends and the growth potential of capital gains. It is worth remembering that both dividends and capital gains carry risk. The value of your investments can go down, and you can have capital losses if you sell for less than you paid. This is another reason diversification is important. Having different types of investments can help smooth out the ups and downs, so you are not relying entirely on one source of return. For long-term investors, capital gains can be powerful. Even small increases in value can add up over decades. By holding investments and letting them grow, you give yourself the chance to benefit from compounding the process, where gains generate their own gains over time. Combined with reinvested dividends, this can create strong growth without the need for constant buying and selling. In the next chapter, we will explore how taxes fit into all of this. You will see how dividends, capital gains, and other types of investment income are taxed, and how understanding the rules can help you keep more of what you earn. Taxes may not be the most exciting part of investing, but they are an important one, and knowing how they work can give you more control over your results. And as we move into that topic, you might find yourself asking a practical question. If the way you invest can change how much you owe in taxes, what simple choices can you make today to set yourself up for a lighter bill tomorrow? That is what we will begin to answer next. Taxes are a part of investing that many people would rather avoid thinking about, but understanding them can make a real difference in how much of your investment gains you keep. Every dollar you save in taxes is a dollar that can stay invested and continue working for you. Taxes are not something to fear, but they are something to plan for. When you know the basics, you can make choices that help you keep more of your returns over time. In the United States, there are a few main ways your investments can be taxed. One is through capital gains, which we talked about in the last chapter. If you sell an investment for more than you paid, the profit is taxed. The amount you pay depends on how long you held the investment. Short-term capital gains, for investments held for 1 year or less, are taxed at your regular income tax rate. Long-term capital gains, for investments held more than a year, are usually taxed at a lower rate. This is one reason many investors hold on to investments for the long term. Another way investments are taxed is through dividends. If a company or fund pays you a dividend, you may owe tax on that income in the year you receive it. Some dividends are called qualified dividends, and these are taxed at the lower long-term capital gains rates. Others are called ordinary dividends, and these are taxed as regular income. Whether a dividend is qualified depends on specific rules about the type of company and how long you have held the investment. Interest income, such as from bonds or savings accounts, is usually taxed as ordinary income. Even though it may feel different from stock dividends, the tax treatment can be similar. This means interest payments can add to your taxable income for the year. There are also ways to reduce the amount you pay in taxes on your investments. One is by using tax-advantaged accounts. In the US, accounts like a 401k or an IRA allow you to invest in a way that delays or reduces taxes. With a traditional IRA or a 401k, you may get a tax deduction for the money you put in, and you do not pay taxes on the gains until you withdraw the money in retirement. With a Roth IRA or Roth 401k, you pay taxes on the money before you invest it, but you do not pay taxes on the gains when you withdraw them later. Another strategy is called tax loss harvesting. This involves selling investments that have lost value to offset the gains from other investments. The losses can reduce the amount of your gains that are taxed, and in some cases, you can also use them to reduce your regular income. This is a more advanced approach and needs to be done carefully to follow tax rules. ETFs often have an advantage over mutual funds. When it comes to taxes, because of the way ETFs are structured, they can limit the taxable capital gains passed on to investors. This does not mean ETFs are tax-free, but it can make them more efficient, especially for people who hold investments in taxable accounts. Even small choices, like when you sell an investment, can affect your taxes. Selling a stock you have held for 11 months could mean paying a higher short-term rate, instead of waiting 1 more month to get the lower long-term rate. Paying attention to timing can save you money without changing your investment plan. Taxes are not something to ignore until the end of the year. Keeping them in mind as you invest can help you make small adjustments that add up over time. The goal is not to avoid taxes completely, that is not realistic, but to be smart about when and how they apply. In the next chapter, we will look at how all the pieces we have discussed so far, costs, dividends, capital gains, and taxes, come together to show your total return. This will give you a clear picture of what you are really earning from your investments and why understanding the full picture matters for your long-term goals. And as we step into that part of the story, you might start to ask yourself a simple but important question. If you know your total return, how can you use that information to make better choices for your future? So that is where we will go next. When you look at your investments, it is easy to notice the current price and compare it to the day you bought in. That change in price is important, but it does not tell you the full story. The real story is your total return. This is everything your investment has given you, the growth in value, the income it has paid, and the costs and taxes that have been taken out. Seeing the whole picture helps you understand how your investments are truly performing. Total return starts with capital gains. These are the profits from selling an investment for more than you paid. If you bought a stock at $50 and sold it at $70, you made a $20 gain per share. If you still own the investment and its value has gone up, that is called an unrealized gain. Even though you have not sold yet, that gain still adds to your total return. The next part of total return comes from income. This can be dividends from stocks or funds, or interest from bonds and savings accounts. These payments may seem small at first, but over time they can add up and play an important role in your growth. When these payments are reinvested, they can help your money grow faster, because they begin to earn returns of their own. From this combined growth in income, you subtract the costs. Expense ratios, trading fees, and other charges reduce what you keep. Taxes also take a share. These reductions are not always obvious when you look at your account balance, but over years they can have a big effect. This is why it matters to know what you are paying and to find ways to keep costs as low as possible without losing the quality you need. Looking at total return helps you compare investments more fairly. One fund might have a higher price gain, while another provides more income through dividends. By adding both parts together, you see which one has given you more overall. This can change how you think about performance. Sometimes the steadier investment, with both modest growth and consistent income, ends up giving you a better return than something that looks exciting but is unpredictable. Total return is also a useful guide for making changes. If an investment is giving you a good total return for the level of risk you are taking, it might make sense to keep it, even if its price has not grown as quickly as others. On the other hand, if a high-cost investment is delivering no better results than a cheaper alternative, it might be time to consider a switch. This is not about chasing what worked best recently, but about making sure each part of your portfolio is earning its place. It is important to remember that total return can be negative at times. Markets move up and down, and there will be years when the value of your investments drops. Dividends and interest can soften the loss, but they may not remove it completely. This is normal and part of the investing process. What matters is how your total return looks over longer periods, like 5 or 10 years, rather than focusing only on short-term results. Seeing the whole picture can also make investing less stressful. When you know that your returns come from multiple sources, you can appreciate the role each plays. Even if the market is down, your dividends may still arrive. Even if you do not sell an investment, its unrealized gains may be building quietly in the background. This understanding can help you stay committed to your plan through all kinds of market conditions. Many brokers and investment platforms make it easier to see your total return by showing your gains, income, and costs in one place. This can give you a clearer sense of where your returns are coming from and how much you are keeping after expenses. Making a habit of reviewing this information once or twice a year can keep you informed without falling into the trap of checking your account too often. ETFs and index funds make tracking total returns simpler because they combine price changes and income in one investment. You can see how the whole package is working for you without having to calculate each part yourself. This is one reason they are popular for long-term investors who want to focus on the big picture rather than daily changes. In the next chapter, we will step away from numbers and focus on something that can be even more important. Your mindset, patience, discipline, and emotional steadiness can help you follow your plan when markets are noisy and unpredictable. Even with the best information, it is how you act over time that shapes your results. And as we move into that part of the discussion, you might start to wonder a question every investor faces sooner or later. If the best results often come from staying invested, How do you keep your emotions from making you change course too soon? That is where we will go next. Investing is not only about what you know, it is also about how you feel and how you respond to what happens in the market. Even the most carefully planned strategy can be disrupted by strong emotions. If you are not prepared for them, the calm investor's mindset is about building habits and perspectives that help you make steady decisions, even when prices swing up and down. One of the most important parts of staying calm is understanding that markets are meant to move. Prices rise and fall in cycles. There will be periods of strong growth, times of decline, and stretches where nothing much seems to happen. When you expect these changes, they feel less like surprises and more like part of the natural process. This helps you avoid reacting too quickly when you see your investments drop in value. Patience is another key part of this mindset. Successful investing often takes years or decades, not weeks or months. A long-term view allows you to see short-term drops as temporary instead of permanent losses. It is easier to wait for recovery when you remember that history shows markets tend to grow over time, even after setbacks. Patience does not mean ignoring what is happening, but it does mean not rushing to act on every change. Discipline helps you follow your plan. This means deciding in advance how much you will invest, where you will put your money, and how often you will check your progress. By setting these rules for yourself, you reduce the chance of making sudden decisions based on fear or excitement. Discipline is not about being strict for the sake of it. It is about protecting your long-term goals from the pull of short-term emotions. It can also help to focus on what you can control. You cannot control the market, interest rates, or global events. But you can control how much you save, the costs you pay, and the balance of investments in your portfolio. By putting your attention on these factors, you build confidence and reduce stress, because you know you are doing what you can to improve your results. Another part of the calm mindset is learning to accept uncertainty. No one can predict exactly what will happen next. Even experts are often wrong about the market's direction in the short term. Accepting this reality can make investing feel lighter, because you stop trying to guess the future and instead focus on building a plan that can handle many different outcomes. For some people, writing down their reasons for investing can help. This could be saving for retirement, building a safety net, or creating future income. When the market gets rough, reading your reasons can remind you why you started and why staying the course still matters. It turns a moment of doubt into a chance to reconnect with your purpose. Checking your investments too often can make it harder to stay calm. Daily or hourly changes can create unnecessary worry and lead to emotional decisions. Many long-term investors check their accounts on a set schedule, such as once a month or once a quarter. This keeps them informed without pulling them into constant reaction mode. It is also useful to remember that downturns can create opportunities. If you continue to invest regularly, you may be buying at lower prices during market declines, which can help your returns when prices recover. Seeing downturns as part of the growth process can shift your perspective from fear to patience. Building a calm investor's mindset takes time. Each period of market change gives you a chance to practice responding with patience and discipline. Over the years, this mindset becomes a natural part of how you approach your money. It helps you stay steady when others feel pressured to act, and it allows your investments the time they need to grow. In the next chapter, we will bring everything together and look at how stocks and ETFs fit into a long-term investment plan. We will explore how to choose between them, how they can work together, and how to match them to your own goals and comfort level. And as we move into that part of the discussion, you might find yourself asking one last important question. If both stocks and ETFs have their strengths, how do you decide which will guide your path forward? That is where we will go next. By now, you have seen the differences between stocks and ETFs, how they work, and the ways they can shape your investing journey. The choice between them is not always one or the other. For many people, the answer is both. Each has strengths that can serve you in different ways, and blending them can create a balance that fits your goals and comfort level. Owning individual stocks gives you direct ownership in a single company. You share in its successes and its struggles. If the company grows, the value of your shares can rise, and you might receive dividends as part of the profits. Stocks can offer high growth potential, but they also carry more risk, because the value depends on the results of one business. If something goes wrong for that company, the impact can be big. ETFs, on the other hand, hold a group of investments. often tracking an index or a specific part of the market. By owning an ETF, you are spreading your risk across many companies or assets in one purchase. This diversification can make the ride smoother, even if individual parts of the ETF go up or down. ETFs can also be an easy way to access areas of the market you would not have time or knowledge to research on your own. Some investors prefer stocks because they enjoy studying companies, reading financial reports, and making decisions about which ones to own. Others prefer ETFs because they want a simple, ready-made portfolio they can buy and hold without much maintenance. And then there are investors who use both. Stocks for focused growth opportunities and ETFs for steady, broad-based exposure to the market. When you decide how much to put into stocks versus ETFs, think about your goals. If you are looking for long-term growth with less day-to-day management, you might choose to make ETFs the foundation of your portfolio. If you want to try for higher returns in certain areas and are comfortable with more research and risk, you might add individual stocks on top of that base. Your time horizon also matters. If you are investing for decades, you can afford more short-term ups and downs, which might make individual stocks more appealing for part of your portfolio. If you need the money sooner, ETFs with broad diversification might help protect against large losses from a single company. Costs can also influence your choice. ETFs usually have low expense ratios, and if you choose commission-free trading, they can be inexpensive to buy and hold. Stocks have no ongoing expense ratio, but building a diversified portfolio with individual stocks takes time, research, and sometimes more trades, which can add costs if your broker charges fees. Another way to think about the decision is to look at your comfort with volatility. If sharp swings in value make you uneasy, a larger share in ETFs may help you stay calm. If you enjoy following certain companies and can handle the ups and downs, individual stocks may give you the connection and engagement you want. Using both stocks and ETFs lets you shape your portfolio to reflect both stability and opportunity. The ETFs give you a steady core, while the stocks allow for focused growth in areas you believe in. This approach can help you stay invested through different market conditions, because you are not relying entirely on one type of investment. The choice between stocks, ETFs, or both is not permanent. You can adjust your balance over time as your goals, knowledge, and comfort level change. What works for you now might not be the same in 10 years, and that is part of the journey. In the next chapter, we will close this series by pulling together everything we have learned. We will look at how understanding the difference between stocks and ETFs is not only about choosing investments, but also about understanding yourself as an investor. Because in the end, the right choice is the one that helps you stay steady and confident for the long run. And as we take that final step, you might notice a deeper question forming. If your investments are a reflection of your goals and values, what story do you want them to tell in the years ahead? That is where we will finish our journey. Every portfolio tells a story. It reflects your goals, your beliefs about the future, and the way you choose to balance risk and reward. For some, it is a story of steady patience, built on broad market ETFs and long-term growth. For others, it is a story of curiosity and focus, shaped by carefully chosen individual stocks. And for many, it is a mix of both a quiet blend of stability and opportunity. The stocks you choose might represent companies whose products you use, whose values you support, or whose growth you believe in. Each share is a small stake in their journey. The ETFs you hold might represent whole markets, industries, or global regions, giving you a way to participate in many stories at once. Together, they form a picture of what you believe is worth investing in. Building your portfolio is not a one-time event. It is a process that shifts as your life changes. Early on, you might focus more on growth, taking on more volatility, because you have time to recover from market swings. Later, you might adjust toward more stable holdings to protect what you have built. Each stage of life adds a new chapter to your investment story. Your portfolio also reflects how you handle uncertainty. Every investor faces moments when the market drops, when the news feels heavy, and when doubt creeps in. The way you respond shapes both your results and your experience along the way. A portfolio you can hold with confidence through difficult times is more valuable than one that looks perfect only when the market is calm. It helps to revisit your goals from time to time. Are you investing for retirement, for a future purchase, for a sense of security, or for financial independence? Knowing your reason makes it easier to choose investments that fit. It also helps you resist the pull of short-term trends that may not serve your long-term plan. A balanced portfolio, whether built from stocks, ETFs, or both, gives you the tools to weather different market conditions. Some parts may grow faster in certain years, while others hold steady when the market slows. Over time, this mix can smooth the journey and help you stay invested through the ups and downs. Your story as an investor is not about predicting the future perfectly. It is about making thoughtful choices, adjusting when needed, and allowing time for your decisions to work. Even small, consistent steps can lead to meaningful results when you give them years to grow. In the final moments of this journey, we will step back from the details and look at the bigger picture. Understanding the difference between stocks and ETFs is not only about making better investments, it is about making choices that match your personality, your values, and your dreams. When your portfolio reflects who you are and where you want to go, it becomes more than numbers on a page. It becomes a personal map toward the life you hope to build. And as we move into our conclusion, you might start to see a simple truth taking shape. The right investment is not only the one that performs well, but the one you can live with peacefully year after year. That is where our story will close. We have reached the quiet end of our journey together. Over these chapters, we have taken our time with the details. We have looked closely at what makes stocks and ETFs different, how each can serve you, and how both can fit into a thoughtful investment plan. But more than that, we have explored how these choices connect to the way you think, feel, and act with your money. Stocks are a direct connection to a single company. They offer growth potential and the chance to participate in a business you believe in. But they also carry the weight of that company's risks. ETFs bring you diversification in a single purchase, giving you a mix of companies or assets so that one loss does not define your results. Each has its place, and neither is perfect for every situation. We have talked about returns, not only price gains, but also the steady income of dividends and the impact of costs and taxes. We have seen how total return tells the whole story and how patience and discipline can make a bigger difference than reacting to every twist in the market. These lessons are not about memorizing facts. They are about understanding the principles that help you invest with both confidence and calm. Your portfolio, whether built from stocks, ETFs, or a blend, is a reflection of you. It shows your goals, your tolerance for change, and your approach to uncertainty. It grows with you as your life changes, shifting to match your priorities over time. The best portfolio is not the one with the highest return in a single year, but the one you can stay with through both highs and lows. The difference between stocks and ETFs is more than structure. It is about choice. Choice in how you want to grow your wealth. Choice in how you balance risk and reward. Choice in how much time you want to spend managing your investments. These are not decisions to rush. They are decisions to approach slowly, with the same care you would give to anything that matters for your future. If you remember one thing from this time together, let it be this. Investing is not a race. It is a steady walk toward your goals. The path will have changes in pace, moments of stillness, and stretches where the view is unclear. But if you keep moving forward with patience, awareness, and balance, your chances of reaching those goals grow stronger. You have learned the mechanics, what stocks are, what ETFs are, how they work, and how they can serve you. You have also touched the deeper side of investing: your mindset, your habits, and your ability to stay steady in the face of uncertainty. These are the parts that turn knowledge into lasting results. Tonight, you can let your mind rest, knowing you have taken the time to understand something that often feels confusing. You have added another piece to your financial foundation, one that can support you for years to come. You do not need to decide everything now. You can let the ideas settle, and when you are ready, you can take the next step that feels right for you. The markets will keep moving. Prices will rise and fall. Opinions will shift. But your decisions can be grounded in what you know matters most to you. Whether that is growth, income, stability, or a mix of all three, you have the ability to shape your portfolio so it serves your life, not the other way around. So breathe. Let go of the need to know every answer tonight. The right path for you will reveal itself in time, shaped by your goals and your willingness to keep going, one calm step at a time. Tomorrow, the market will still be there, your opportunities will still be there, and you will be ready to meet them with clarity, patience, and the quiet confidence that comes from understanding your choices. Good night, and may your journey with money feel lighter, steadier, and more your own with every passing year.